the fact is that we're looking at the earnings season that's just concluded. It's not been a very blockbuster, so to speak, earnings season at all. Let's put the spotlight specifically on the financial space and talk about what lies ahead. Q3 was fairly modest for the BFSI space as well. But now what is FY26 looking like? What are we in for, considering the rate cut cycle has just begun here in India? Nitin Agarwal, who's head of BFSI Research at Motilal Oswal Institutional Equities, is with us. Thanks very much for joining in, Nitin. So that's the real question. As these rate cuts get underway, what can we expect? We've seen a little bit of a hiccup in asset quality. MFI issues are still persisting. But NBFCs went ahead and met the governor, and there's hope that they'll have better and easier access to funds. So let's start with your big picture in terms of, if you were to look at buying or adding to any BFSI positions, what is looking the best to you?
Yeah. So good morning, Subhi. Yes, with the start of the rate cut now, we will see further sort of compression in bank margins. While a large part of it has already played as the funding cost kept on rising over the last year. But as now the lending yield also reprices and the loans which are linked to repo rate reprices down, there will be some incremental pressure on margins that we will see in the coming quarters. And depending on how and at what pace RBI moves, I think bank NIMs will be linked to that extent. And NBFCs, on the other hand, select NBFCs, especially the ones who are in the vehicle business, will likely see NIM expansion because their large part of their borrowings comes from by way of banks. And as their funding cost comes down, they will likely see a uptick in their NIMs in the coming year or coming quarters, I will say. And but it will be for select NBFCs, I think, because especially for say housing finance companies, if you look at, I think they may still continue to see some NIM pressures. And the picture may remain mixed there. But for passenger vehicle players and the CV players, I think there is a good case of NIM expansion to play out over the year.
All right. Hi, Nitin. Good morning and good to see you, Ben. Let's focus on Kotak. Yesterday we had an exclusive chat. The top boss out there, Mr. Vaswani, had a chat with our top boss, Shreen. And what he said was, with the launch of 811, he hoped to add close to around 4 to 5 lakh customers a month. Do you think that number is something that you would be working with as well, or do you think he's being too ambitious?
I think yes, because see, Kotak has lived through this ban over the last 1 year. They navigated along still pretty well and handled all the uncertainties and still delivered a pretty reasonably good growth overall. And now with the ban getting lifted, I think the team overall is quite energized and looking to go for it and make up for the loss that they have seen in the past 1 year, because the market share in credit card has come down quite meaningfully. And now with the renewed focus on growing the consumer business, they have already done some acquisitions. And in the card space, while the overall markets are still not very conducive when it comes to unsecured loans, but Kotak, having not been able to grow in this kind of market, was kind of a blessing in disguise, I'll say. And to that extent, now as they come back fully in the market and look to grow the unsecured portfolio, I think the bank is better positioned to deliver stronger growth versus many other private names. So we have also upgraded Kotak alongside the 3Q results.
All right, so you've upgraded Kotak. So let's get stock specific now. Nitin, with the kind of results that you've seen in the third quarter and the kind of environment that we are in right now, where do you see maximum credit growth coming in? Which companies stood out in the third quarter results for better performance over the next few quarters? And from an industry standpoint, what is your expectation on credit growth and asset quality?
Yeah. So, Mangalam, we are looking at overall around 10.5-11% kind of industry growth for this year. And even for next year, I think the numbers will be only slightly better, somewhere around 11.5 to 12 is what we are looking at when it comes to credit growth. And deposits is something that continues to remain a challenge for the overall sector. And the CD ratios for many banks still remains elevated. Even PSU banks are now looking at a fairly optimized balance sheet, and CD ratio for many of them have approached 75. And few banks like Bank of Baroda are already in early 80s. So to that extent, I think deposits will continue to guide loan growth, while at the margin, given the regulatory steps in terms of the reduced repo rate, and which will continue likely, and alongside the measures on the budget that the government has announced, may spur some demand on the consumer side. But the actual translation of that in terms of growth, I think, will still be relatively controlled. And so to that extent, we are expecting only a slight uptick in FY26 growth numbers over FY25. And when it comes to stock, I think large banks are doing relatively much better in this part of the cycle, while NIM compression is playing out, but that pace has come down very meaningfully. And on the asset quality side, the larger banks, like you look at ICICI, HDFC, they are all reporting very stable trends. So the pain that we are seeing is very much limited to the unsecured segments, and within that, the MFI and credit card. And it's only impacting the select mid-sized banks and those players. And I think these trends are likely to continue, while overall credit costs will see some uptick, but we are penciling in a calibrated upticks over there. And to that extent, ROAs will still remain fairly healthy for the large banks, and that's where our preference lies in the current markets.
Okay, so Gaurav, that explains why you like stocks like ICICI Bank, HDFC Bank. I think these are some of your large cap picks. On NBFCs, Nitin, you mentioned that some select NBFCs could actually see, that pressure on NIMs to come off. Maybe NIMs even improve, are you saying? Which ones would this be? Would Bajaj Finance make the cut? Essentially, what are you buying in NBFCs?
I think, vehicle financiers looks interesting because the valuations overall are quite reasonable for them. And now, with the way the utilization levels are expected to move up, and in respect to the demand that is going to see some recovery, and alongside the funding costs which will come down, because for these vehicle happen by way of banks, borrowing from the banks, and that interest rate will come down and linked to the repo, and therefore players like Shriram, Chola may see some recovery in margins over the year. And these are the, Shriram is one name, MMFS is another name that we like a lot in the vehicle space. So Shriram, MMFS are the names that we like.
Okay, so Shriram and Mahindra Financial as well. Final question, Nitin. I mean, we've seen the MFI stress, and you're saying probably the worst of it has played out or is playing out now in the fourth quarter. Is there any other pocket in tier 2 banking as well? Any other accidents that we need to be watchful of, potential accidents? Because all the banks you named are the pristine quality A-grade banks. What about tier 2 lenders and anything else? Any other red flags on the horizon?
I think, MFI as a space still continues to face the headwinds. We are still not fully out of it. And once the new guardrails comes into effect from the next quarter, we will still need to see how the industry takes up to that, how the borrower behavior is, and what kind of growth rate are we really looking at. So possibly the stress and the elevated credit costs will continue for a couple of more quarters, and hopefully from second quarter of 26, you will see the normalcy returning to the sector. And while there has been an improvement in collection efficiencies across states on a month-on-month basis, but this is still not good enough to take them home. And to that extent, I think the overall slippages and the credit cost will remain elevated, and it will take time for the sector to come out of it, and because there are very acute problems of over-leveraging. And this guardrail related impact is something out there which also needs to be watched out for.
Right, Nitin, thank you so much for joining in. Always a pleasure speaking with you.